This is T4 Lesson 1. Up to now, how have you picked your entries? Chart shapes? Gut feel? Starting today, we decide with math. What you'll learn: what expected value actually is, why high win rate trading still fails to make money, how to escape a negative EV setup. With expected value alone, you can judge in advance whether setup is an edge or a leak, whether you're trading the S&P 500, the ASA, or Bitcoin on screen. After chart reading comes the math. Let's learn it together. Expected value is the average outcome if you repeated one trade forever. Not luck, mathematical expectation. The formula: win rate times average win minus loss rate times average loss. Example: 50% win rate. You make $100 when you win and lose $80 when you lose. If 0.500, 0.580, 50-40 dollars. If that number is positive, repeating the trade drifts your account upward. If it's negative, repeating only stacks losses. Any single trade is luck. But over 100 or 1,000 trades, results converge toward expected value, the same way long-run index returns settle around the Fed cycle, not one lucky week. The key: a high win rate does not guarantee high profits. And the flip side, you can still make serious money at a low win rate.
Why?
Because risk-reward is doing the work. Take bigger winners and keep losers small, then what? Concrete example: 35% win rate, $500 when you win, $200 when you lose. EV equals 0.35 by 500 minus 0.65 by 200 equals 175 minus 130 equals $45.
Positive.
Pros don't chase winning often. They hunt positive EV setups and repeat them, whether the backdrop is the S&P 500 or not. Let's compare two trading patterns side by side. Pattern A: 60% win rate, $100 when you win, $100 when you lose. Raman EV equals 0.6 by 100 minus 0.4 by 100 equals $20. Pattern B: 40% win rate, $150 when you win, $50 when you lose. Raman EV equals 0.4 by 150 minus 0.6 by 50 equals $30. Pattern A wins more often, but pattern B has the higher expected value. Which would you choose? The answer is pattern B, the one with the bigger EV. Now, the opposite case. You make $100 when you win, but lose $150 when you're wrong.
이분 at A 60%인 레잇, EV 0.6 곱하기 사인 100, 마이너스 0.4 곱하기 사인 150, 60 마이너스 60 0.
Expected value is 0. Repeat forever, and P&L goes nowhere. Worse, if losses are $200, EV equals 60 minus 80 equals minus $20. Negative. Now every repeat shrinks the account. Negative expected value is the casino. A high win rate still won't pay you. You have to get out of that structure. Caution: a positive EV does not mean the next trade must win. 1 or 2 trades are just luck. But over 100 or 1,000 repeats, results converge toward expected value. That's the law of large numbers, a mathematical truth, not a market opinion. So professionals do this. Find a positive EV approach and run it consistently. Check results after about 100 trades. Don't flinch at 1 or 2 losers. Trust the EV over the long run and keep executing. Same mindset as writing this and pay 500 through a noisy Fed week instead of judging everything on Monday's candle. T4 Lesson 1 Wrap: expected value equals win rate times average win minus loss rate times average loss, the average outcome if you repeat one trade forever. Risk-reward structure, not win rate, drives profits. You cannot make money with negative expected value. Next lesson, Lesson 2, Validating Expected Value. How to compute and verify this EV on real historical data with backtests. You'll be able to check, with math, whether your own approach is truly an edge. This lesson is for education only and is not investment advice. You alone are responsible for every trade. Please subscribe and like if this helped.